Welcome to an exclusive journey into the heart of financial trading. Today, Lan Turner, former instructor at the Chicago Board of Trade, opens the doors to his live class, offering a rare glimpse into his tactical use of the RAFF Regression tool within the revolutionary track and trade platform. Watch closely as he skillfully navigates the complexities of the market, deploying vertical spreads and iron condors with precision and expertise.
We're going to come in and we're going to hit the RAFF. This is the RAFF tool right here, RAFF regression line. And you're going to come in and you just draw it along the trend, just like that, from high to low, from high to low, high to low. And you can go longer trends like this. And this is where you come in and you see the market stays within, and I'm going to do it again. See, it stays within that cone of probability, the single level of distribution, right? The deviation, 1-to-1 deviation, or the two standard deviations. So now we're going to go see if I can go back to the charts again. All right. So we're going to go to the two standard deviations. So I'm going to click on the RAFF. I'm going to come over to the preferences, and in the RAFF, I have this normal and I have two standard deviations. So we go normal, which just kind of brackets the highs and lows automatically, or you can go to two standard deviations. You click that and it calculates two standard deviations. In this case, it was exactly the same. Let's see if we go two standard deviations. There we go. So see, the two standard deviations on that uptrend is much wider. So what I like to do is this, where I go back to that. We'll go back to the 15-minute chart where I was before. So we'll go back to the 15-minute chart, and depending on how long you want to take. So I have kind of a standard rule. If I'm going to kind of measure where the market's been, or where I think the market, where the expiration of my option is. If I'm going to do an option, option's going to expire in 31 bars. So I like to double it. So go back, 60 bars. So there's 30, 40, 50, 60 bars. So we'll go back 60 bars. We then grab that RAFF tool and we include 60 points of data along that line. And if that's the case, that's what that RAFF is telling us. Now we have to take into consideration this was a lot of nighttime session stuff. That's a whole day's time frame on a 15-minute chart. But that RAFF is now telling us, if we come into the preferences, we go to normal, or we can go to two standard deviations. Two standard deviations is right here. So two standard deviations might be a little smaller than, depending on how much data you're taking and how big the market moves. So that's two standard deviations. So that's saying the market should stay inside this box to expiration. So now, what does that mean to us, Lan? Well, it helps us know if the market gets down into this region here, we can turn on our stochastics indicator. Why that's not on, I don't know. Stochastics indicator will probably come down into this oversold region. The market should come down. It should test this RAFF zone down in here, and then it should turn at that point and go back up. Same thing on the upside. If it comes up here and tests this, stochastics indicator should be way up here in the overbought region, and the market should come back down. It should stay inside of here. However it stays, it should stay inside of there, right? So we should see it just wander around in here all the way to expiration. Now, it doesn't mean it can't get excited and it can't break out and go up and do this kind of thing. Certainly can. Doesn't mean it can't come down here and do this. Certainly can. We're just trading the probabilities, right? So what are the probabilities? Once again, the probabilities, 68.2% of the chance it's going to break out of that RAFF, and 95% that it's going to go outside the two standard deviations. So on the RAFF, we don't have two standard deviations. We only have, we do. We have normal, that's one standard deviation. Then we have two standard deviations. So there's your two standard deviations. So you got a pretty good high percentage, 90% chance that it's not going to go outside that RAFF. So that's what that's all about. Okay. And the problem is that it depends on how much data you take into consideration. I mean, if you draw, is it going to be 90% there? You got three bar chance. Well, the more data you take into consideration, the bigger the movement of the RAFF. In your day trading, you can say, well, I'm going to only trade inside the RAFF, or when when the market gets down into this region, that's where I'm going to start looking for longs, or when it gets up in this region, that's where I'm going to look for shorts. So that's what that's all about. But then we can come in with options, right? Because we can come into options and we can come in, I'm going to do a 0 DTE, and I can sell a call outside the RAFF. Okay. So that's what I want. I want that to be outside the RAFF. So 137.50, I can take that, sell that. And then I have, what do I have? I have basically a 68.2% chance that it's going to stay inside that RAFF, but I can also come down to my option. I can raise my options up, go to my options chain, and I can look at this, and the options chain has a probability on it. So in here, this is a call option, and I'm selling it, and it says I have a probability of being out of the money, 75.98%. So it says I have a 75% chance that market's going to make money for me. Okay, by expiration, I got a 75% chance that it's not going to be below there. If it does, I got 137.50 that I get to collect. And I could make it sooner. I mean, if the market continues to fall, if it just dumps right here, I'll make that money a lot faster. But if I have to wait for it to go all through there, and if it actually comes up and tests it, it just has to stay below that red line. It just has to hit that purple line before it hits that red line, and I get to keep all $137. Now that's a cash secured put, which means that I have a big margin, $12,494. We talked about that last week, right? Well, if you want to cash secure it with the money that's in your account, you can do that. Then you don't have to buy insurance. But if you don't have $12,494 to risk, then you're not risking all $12,494. Well, technically you are, because the market could go to the moon where you could lose $12,494. That's the point, right? Chance that happens pretty slim, but nonetheless, you're going to receive $122 if it stays below that red line, and you got a 75% chance it's going to do that. You've measured the RAFF. You got a 90% chance it's going to stay inside, or 60% chance it's going to stay inside that 2 standard deviations. Or no, 2 standard deviations is higher, right? 95% chance it's going to stay inside that 2 standard deviations. So that's your odds. You're just kind of doing your swag. A scientific wild ass guess. This market's going to stay inside that RAFF below that red line, hit that purple line first, and you're going to make $122 if it does. So margin required to do that is $12,000. I don't want to put on $12,000. So I don't have $12,000. So then you just have to buy a call at the same time as an insurance policy, which in essence will stop your losses at that green line. Right? So then you don't have to have $12,000 of margin. You just buy yourself some insurance policy, you buy a call, and now it'll start making money as much as the red one is losing money. So that's the idea, right? So, but you don't want to buy $82.50 worth of insurance. You could, if you did, you click that in there, you see your margin went all the way down to $194. So now you only have to max loss. They're going to margin you at your max loss. So the max amount of money you could lose is $194. So you say, well, I'm real willing to risk more than that. I got 75% chance it's not going to fall and it's not going to go up there. So I'm going to raise this up, buy less insurance. It's like when you go down to Farmers Insurance Company, you say, I need to buy some insurance for my car, right? They say, well, how much of a deductible do you want? Well, I'm a good driver. I don't need don't you want 100% coverage? That's what they want you to buy, 100% coverage, right? But yeah, I don't want 100% coverage. I don't need that. I can buy a little bit of a deductible. So the more confidence you have in your tools and your swag and your scientific wild ass guess. Oh shit, I just said wild. Oh, I just said shit. Oh shit, I just said wild ass guess and I said shit. I'm gonna have to confess my sins. Damn it. All right, sorry. YouTube sinner. Here we go. So you're gonna buy less insurance because you don't need, because you have a higher confidence in your analysis. You can buy less insurance. If you have less confidence in your analysis, I want to buy more insurance, right? So here we can buy less insurance. So I'm going to raise that up. Now my insurance is $32 because I have to pay for that. I have to pay for that insurance. I have to pay $32.50, and that's going to come out of my $130. So if I'm going to receive $130, I have to subtract $32.50 out of it because that's my insurance policy. So, but that's going to make it so my margin is not $12,000. Okay. But I'm going to have a margin of $623 at this point. So now my max loss is $623. Oh, well, I don't want to have a maximum loss potential of $623. Okay, well, buy more insurance. Now you have a loss percentage of only $400 instead of $600. But now I have to pay $52 instead of $30. That's right. You're buying more insurance. If you're wrong, you lose less, but you pay more for that. But I'm going to be right. It's going to stay inside my RAFF. I'm going to make money. It's never going to go up above that red line. Okay, then buy less insurance. You can buy almost no insurance. Go up there's $20 of insurance. But that means your margin requirement is going to go up to $859. Which means that's your max loss, which means the market would have to go up to that green line. What's the chances of the market going above that green line? If it goes above that green line, by the time it hits that purple line, that's the game you're playing. If it goes above that green line and hits that purple line, you're going to lose $859. What's the chances of it doing that? Well, pretty darn low. 94.95% tells you right there, probability of being out of the money. 94%. You got a 94% chance it's not going to do that. Okay, but that's not a 94% chance it's not going to go above your red line. You got a 74% chance it's going to go above your red line. So it's going to go into your loss zone. You got a 74% chance it's going to go into the loss zone. You got a 94% chance that it's going to hit your max loss of $859 up there. But I did my RAFF and it's going to stay in my RAFF land. Okay, well, put your order on there and get rich, rich, rich beyond your wildest dreams now. because you know how it's going to work. You know how it works. That's how it works. Well, what about if I think it's going to continue up this RAFF because it's bullish? Can I come and put one down here instead? Because I don't think it's going to fall. You absolutely can. Let's go put one on down there and see the comparison between those two. Let's go in here. We're going to delete these out of here, and we'll put one on to the downside. We're going to sell a put down here, and we're going to put it outside the RAFF by expiration. It's inside the RAFF here, but outside the RAFF here. Where do I want it land? Do I want it there or here? Well, depends. Be more conservative. You got your RAFF in there. If you think it's going to be inside the RAFF the whole time, it only has to be inside the RAFF as long as it takes to be inside the RAFF to hit that purple line, because this is a 0 DTE. It's going to expire today. It's just got to hit that purple line before it hits that red line. And you can put that red line closer because it's going to, the RAFF is saying that the market's going up. So it's going to stay kind of relatively bullish. Even if it comes down and does this kind of a thing, it should go back up right before expiration. Who knows? Could come down and go like this. But that's why you buy the insurance. Now you need $12,570. I don't want to do $12,572 land. That's too much money. All right, well, let's buy some insurance then. We're going to come in here and we're going to buy a put this time. Okay, going to buy a put. Because if we sell a put, we're going to collect the premium of $280, but we needed $12,000. I don't want $12,000. I'm going to buy some insurance. The insurance is $142.50. I have to subtract $142 out of my $280, gives me a profit of $142. That's a lot of insurance land. $142 worth of insurance. That means I have a margin requirement of $370, which is my max loss. My return on my risk is 38%. That's pretty darn good. Most guys will wait 3 years to get 38% on their money, but I'm going to get it in the next 4 hours. Yeah, that's called a pretty high risk. All right. Okay. Well, let's look at the risk on this thing. Let's go over to the puts. You got a 64% chance that it's going to stay inside, that thing's going to be profitable. You got a 78% chance you're going to have to pay full loss. Margin requirement, or that's actually, it's the other side of that. You got a 21% chance you're going to have to pay full loss. Well, we could reduce that. Let's bring that out. What's that one? Oh, now you only have a 14% chance you're going to have to pay full loss, but the full loss amount goes up. Margin requirement is $574. Bring it back in just a little bit closer. Now it's $370, but it's still outside that RAFF. That RAFF is your tool right there that's telling you where the likelihood of where that market's going to be at the end of the day. Is it always right? Nope, not always right, but that's your probabilities. Well, maybe I don't want to take that big of a risk, Len. Okay, well, move your insurance out and move your premium collection out. Now you're going to receive, now you have a 14% chance that you're going to have to pay max loss, which is $398. You also have a 26% chance that you're going to have the market come down here into the red line, which means you're going to lose $182. All right. So there's a difference between the $182 and the $398. That's because you're going to lose $182. You're going to crash your car. That's the cost of the accident. Trying to relate this to your insurance. So to your car wrecking. All right. So if you wreck your car, you're going to have $182.50 in damages, and you're going to have to pay $87.50 in insurance, so you don't have to total your car for $12,500. How's that sound? Is that a good analogy? I like it. All right. So that's the name of the game. And then the probabilities that somebody's going to hit you while you're driving drunk down the road is 85% here or 72% here on the probabilities out of the money. Probabilities in the money is 27.24 and 14.43. So your probabilities of losing money are down here, 14, 44, and 27. And these are the probabilities you're going to make money. 85% of you got to actually 72% that you're going to make money, 72% chance that you're going to make money. And that RAFF says that you got, it's going to be inside the RAFF. That's how we use the RAFF. And you're like, well, Lan, that's pretty cool. If it's going to stay in the RAFF, why don't I put on both sides? Why don't I put on both sides? I could sell a call, sell a put here, put on my insurance policy. I could come up here and I could sell a call up here, sell a call, and I could buy a call up there for 57. Now I got one on both sides because, hey, if it's going to stay in the RAFF, okay, you know what that's called? That's called an iron condor. That's an app. That's a strategy you can do. These are called vertical spreads up here, vertical spreads. And when you do one on the top and you do one on the bottom, you combine them together. That's called an iron condor. That's how you do iron condors. You get your RAFF, you find out your probabilities, where you think that market's going to be by the time it hits that purple line, and you set your wings of your iron condor or your vertical call and put spreads outside of that probability statement. Now, you could come in and say, well, I want to be more conservative. Okay, we'll put them out farther. And you can put this one out farther.
This isn't just another trading tutorial. It's a masterclass in strategy, an opportunity to learn from a master trader as he shares the secrets of his success. Lan Turner doesn't just trade, he crafts opportunities, turning market movements into profitable ventures with the aid of the RAFF Regression tool. Please like and subscribe to receive notifications when Lan Turner posts new innovative trading strategy videos.